Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
The CUInsight headline caught my eye. Why credit unions must step up as financial stabilizers to rebuild consumer confidence. The piece was authored by Dave Buerger, CEO of Union Credit, and before that he was CEO of CUInsight, where he was a co-founder. At Union Credit, the mission is delivering one-click perpetual loans to credit union members. 70-plus credit unions are Union Credit customers, and a key to Union Credit's business is that it memberizes non-members in a very few minutes. That's a big hurdle, but Union Credit has the tools that resolves that problem very fast. Now, what triggered Buerger's piece is a consumer confidence survey commissioned by Union Credit that found that consumer confidence is shaky indeed. Takeaways from the survey are, and I quote, only 12.5% feel very confident about their finances. The majority are in the middle, with 57% rating themselves as 3 or 4 out of 5. 54% are feeling cautious, 45% anxious, and 30% overwhelmed. And no wonder many institutions are experiencing a slowing loan volume. Buerger believes credit unions can take steps to strengthen consumer confidence. In the CUInsight piece, he wrote, and I quote, consumers are pressing pause, not stop. They're delaying major financial decisions because they don't feel safe committing before they understand their options. Yet 36% told us they would still move forward with financing if the offer felt secure and transparent. That gap between hesitation and action is where credit unions have both a responsibility and an opportunity. In the show today, he elaborates on those thoughts. Buerger's optimistic, but he's realistic as well. Opportunity is knocking for you. And Buerger firmly believes that Union Credit's tools can help credit unions improve their loan volume. Listen up. Why did you do a consumer confidence poll snapshot?
So the consumer confidence survey, that came out of really looking at results over the course of the last 2 years of our program and starting to see some patterns emerging throughout 2025. I think it was an interesting year from the get-go, right? You saw tariff scares early in the year. The government shutdown is really what I think prompted this research. But it was an odd year for the markets, and we saw that, or we started to suspect that some of the patterns we were seeing had to do with consumer confidence around the uncertainty in the market. And I think that proved to be true through the research that market research team did in that survey.
That, to me, represents a big change because for many years, the American consumer was extremely optimistic. Now, with confidence down, instead of running out and buying that $50,000 or $60,000 new car, you think, well, maybe I should just buy a $5,000 banger and hope the thing lasts me for 6 months.
Right.
And that consumer is not being stupid, really. I wouldn't say, hey, hold on.
Still have needs, right? And they still have both needs and desires and dreams that they'd like to fulfill. And, credit plays a big part in that. But I think it has more to do with caution, that they're uncertainty around making the right choice at the right time. Interest rates, where are they going to be? They're going up, and then they're going down. So it starts to really wear on the consumer's decision-making, capability. And so what do they do is they freeze up, right? Instead of, just acting confidently, going out to the dealership, buying the car because rates are low and times are good, everything seems very stable. It shifts to more of this, well, I want the car, I need the car, but is now the right time? Or should I be waiting a little longer? Or, what's going to happen? And that anxiety, I think, drives a lot of consumer behavior.
Yeah, I think and I hadn't really put this together until looking at your research. I know several people who went out and bought lightly used cars from dealerships with a good warranty. It was almost like buying a new car, but significantly cheaper. And yeah, there was some miles on it. And these are people who would have bought a new car 10 years ago. In fact, they had bought new cars. So, something was clicking there where they're saying, I don't have the same robust confidence that I used to have. I'm not sure that was conscious, but looking at their behavior, that's how I'd interpret it.
Yeah, I think that's accurate. And yeah, other market influencers in there where you have the financing options have changed a little bit over the course of the last couple of years, but also you've seen EV credits go away. You've seen resale on especially on the EVs plummet to the point where it's a gamble. Car prices are going up steadily year over year. Resale is coming down. So you see this other hesitation around buying a new car because there's this, you wonder if you're going to lose your butt in the end. The EVs can drop as, like 2/3 over a couple of years. I think that's starting to stabilize a little bit, but also the used car market is the cars being more dependable. They're great buys. Low mileage cars are certified pre-owned vehicles are a great buy.
And with the EVs, I would argue that much of this is not necessarily an EV problem, it's an Elon Musk problem.
No comment, I guess, on that one, but
that's why you and I can walk down the street in Phoenix and see a Cybertruck go up to the guy and say, "Hey, we got like $1.50 in pocket change. Would you consider selling?"
But there are they're fantastic cars. I had an EV, actually. Still, my wife drives an EV, and it's really convenient in a lot of ways. I think a lot of people get scared of range anxiety and where am I going to charge this thing? But actually, we get a lot of miles out of the EV. It's comfortable. It's very low maintenance. It makes a lot of sense for the right type of buyer. But the incentives are starting to go away, financial incentives. But the resale is always the scary thing. Do you buy? Do you lease? What's this thing going to be worth in 2 years when technology's changed? It's like buying a cell phone. You pay a premium for the new phone, and it's worth almost nothing by the time you're ready to get the next one. And going back to the consumer confidence, it's such an unproven market that I think that leads to a decline in confidence in that specific niche. But
yeah, I don't think the slowdown in consumer lending at credit unions, and obviously I'm not an economist, so I'm not, I'm just offering a man on the street opinion, has less to do with interest rates and more to do with lack of confidence. I mean, I had a 30-year fixed rate mortgage years ago. I got it in, I think, 2004, 6.75%. I was very happy with that. That was a good rate in that particular market. Wasn't a great rate, but it was good. And
yeah,
and now people are whining, it's like, you can't buy a house unless it's 3%. Hell, man, come on. Let's be realistic here. So I think and if you're really confident, you say, geez, I don't care if it's 10%. Because, I know I'm going to get a raise. I know my income's going to go up. This is fine. Yeah, it's fine. But if you're lacking confidence, you say, oh, every percentage point matters. And it does in that mindset. Am I not making fun of the consumer? Does any of what I babbled make any sense to you?
it does. And when we in the survey we did, I think it said that there was about 12% of consumers who actually felt very confident in their finances, and that's really low, right? I mean, if you're talking 12% of, that means 80 plus percent of the market is anxious about their or feeling overwhelmed by their finances and the lack of clarity and their ability to make long-term decisions, especially around things that like debt, right? Or big ticket items. The confidence has everything to do with the kind of conditions, right? Economic conditions, political climate, employment. I mean, there's so many things that weigh on the consumer's emotions as they're making these big decisions. And then some of that is also, where should they be accessing this credit? When they need it. There's the confidence in making the purchase, but then there's also the confidence in making the right decision around the financing, because the options that they have available to them now are far more in your face, and they're not always in the best interest. Marketplaces and merchant financing, buy now, pay later. Yeah, all of these easy access to credit is right there in your face where you're tempted to make a purchase, and it's not always the healthiest option. And those with the deep marketing budgets and the ability to penetrate those in the moment opportunities are the ones who are winning. But it's not always because they have the best rate or the best product or the best customer service. It's because that's they're at the right place in the right time. And I think that also contributes to anxiety around the purchase decision, because they don't have time to shop or understand their decisions. A lot of decisions around purchases are made emotionally at the point of purchase. It can be confusing and anxiety provoking.
Yeah, I mean, a lot of the sales process, particularly at an auto dealership, it all unfolds at the end.
Right, and it's
Now,
not
now are you
transparent.
are you are you going to buy this coverage for your tires, which by the way costs $600 a piece, but with this coverage you only pay $50. Now, are you or
Right.
aren't you? You got me. This is the only time I'm going to offer this to you.
The backflips that they do in the finance office are a mystery to me. How they're and to everyone else, there's zero transparency about the rate you're getting or the payment until they've had a chance to work in all the extras. But that's a whole other conversation. I mean,
Well, no,
that hasn't changed.
if
That's been that way for decades.
oh, absolutely. I mean, unless it's changed, and I doubt it has. If you're leasing a car and you say, "What's the interest rate?" They say there is no interest rate on this. This isn't that kind of loan. You go,
Well,
"Oh, okay."
how much would you like to pay per month? You ask them
Well,
what the interest rate, and they say, "Well, what kind of payment can you afford?"
a friend of mine was a car salesman. He said he always turned the conversation to, "Can you afford $400 a month? I can put you in this car. Can you afford 500? I can put you in this car. Price of the car? No, we weren't going to discuss that."
Yeah, and then if you want that paint protection and the tire thing, can you afford just $15 or more? That's it's
Absolutely. So now, okay, in this environment, which I think still persists, I think there's still a lack of consumer confidence. I don't think that was entirely due to the government shutdown.
right.
What can a credit union do to capitalize on this? And a credit union, I think, is in a perfect position because most of them don't do really hinky loans. And they have reputations in the community of being pretty solid insofar as they have any reputation in the community.
Oh, that's right. I mean, I think for those who know about credit unions, and our surveys supported this, our studies supported this. For those who understand what a credit union is, why they exist, and their ability to join a credit union, in many cases, it's going to be the best choice for a lot of their credit needs, right? I mean, the rates are lower, the service is better, all the different benefits of that the credit unions bring to the table, not just rate, but the rates are, consistently better than what we see in, major financial marketplaces from the big banks and fintechs, at least in certain categories. But it's the mystery that this growing number of people or percentage of people in the market, especially emerging segments, younger folks who don't understand what a credit union really is. They think, a credit union, what do I have to join? You have to be part of a union or some sort of labor union to join. The eligibility is really a turnoff to them. Or just something that they're completely unaware of. But for those who do, to some extent, understand what a credit union has to offer, our survey said that, all things equal, they'd prefer to work with a credit union. So messaging and awareness is really key for credit unions, and that's again no mystery there. It's always been the case, and we've been hearing that for years. Is how do we get awareness out to emerging segments about the benefits of joining a credit? That battlefield's becoming even more, it's more important to get embedded into these, types of places where we're seeing the fintechs and the big banks start to gain market share and ground. And that is, at the point of decision inside of purchasing experiences. They're doing a better job with the sort of the experience around getting approved as well. Ability to pre-qualify with no impact to your credit has become sort of table stakes out in the marketplace and even the retail world. But credit unions have been pretty slow to adopt similar technologies. They're requiring consumers to go through an eligibility or even a full membership application before they can actually apply for a loan. And then when they apply, they're not offering that no impact to your credit score type of benefit. They're requiring a full application that will impact credit. And so I think that's a big opportunity for credit unions to improve upon, not just to bring their technology and their customer experiences up to sort of the table stakes or the expectation these days, but also to better serve their existing members.
Yeah, and credit unions have to be prepared to fight. I mean, I remember this is going back 23 years ago, I think. I was buying a Subaru Outback and had a credit pre-approval letter from a credit union, blah, blah, blah. And the finance manager said, I can arrange financing. I said, that's fine. I have my own. Showed him the letter. And he said, I can beat that rate. And I said, what's your rate? And he said, 0, because it was a special chase deal for the life of the loan. And, it wasn't just a year. It was 4 years. And I said, yeah, you beat the rate. You got it, baby.
And that's what any consumer will do, right? I mean, and a lot of times captive financing is just going to win, right? But what happens when somebody doesn't qualify for that 0% rate, or what happens when there is no incentive?
That was auto dealerships talk about tier 1, tier 2, yeah, I think you had to be tier 1 to qualify for that rate, whatever the highest thing was, to get that 0% chase thing.
Yeah, and the auto industry and the auto purchasing experience has always been an issue where you can pre-approve people all day long, your members, and send them, keep them in what we call perpetual state of approval, right? And they will react to those offers, but then many times will get flipped at the dealer when the dealer says either they can get them a better rate or they've got these incentives in place. Age-old problem, and probably not something that's going to change easily in the auto space. But if you look at other purchases, other big ticket items, home equities, home improvement, there's a huge opportunity, I believe, in the home improvement space where your members or non-members have, they're a homeowner, they have strong credit, their furnace breaks down, right? They call the HVAC company, local HVAC company comes over, tells them your furnace is busted. It's going to be, $10,000, $15,000 to repair. Well, not everybody has $10,000 or $15,000 laying around, but to be able to offer that individual financing, local financing from a trusted credit union in their area, a name that they are familiar with on the spot, right? At that, while the HVAC service person is standing in that person's kitchen, showing them, how much this is going to cost, offering the ability to pre-qualify them for a loan from their credit union to pay for that. That's there's no flipping going on in that situation. There's no trickery. The HVAC person is there to, make a sale. The person has a need that needs to be fulfilled, and the credit union has an opportunity to be there with their products and services at that time of need. Those are the types of opportunities that I believe we need to act on as an industry. And that type of use case can be repeated in many different scenarios, not just home improvement and not just, services that are being rendered at the person's home, but at retail, in any type of retail environment. We have clients who are lenders who we work with who offer financing in local hardware stores for purchasing big ticket items like new kitchen cabinets or windows for the home. So it's the same type of, if you think of the auto industry, you have indirect lending, embedded within the dealership, but it's, if you can replicate that type of convenience, but with a much more transparent, consumer-friendly experience tied to it, one that doesn't include the finance guy who's trying to, kind of pull every extra dollar out of you. It's a really big opportunity, that's where one of the things we're trying to move on quickly for the credit unions.
Yeah, so let's talk about where union credit fits into all of this. Yeah, we're talking about backdrop of the various problems. So what solutions does union credit have?
Well, one of our mantras, I say all the time is embed everywhere, and that's what we're attempting to do with our platform. Our technology essentially allows a credit union to be at that point of need. It's a hub, right, that houses all their underwriting criteria for all the various products that they wish to offer, and then we're out there searching for opportunities for new members and existing members to engage with that credit union through a number of different channels. We launched originally with our marketplace channel, so that channel allows credit unions to embed their credit offers within existing major financial marketplaces like the Experian consumer app, where up till now there were just big banks and fintechs making offers inside of that marketplace. But now we're able to present credit union offers alongside those, a lot of times with really strong or very competitive or much better, in a lot of cases, rates. Same with the Lending Tree and other marketplaces like that. So that's our first vertical is helping credit unions compete in existing financial marketplaces where a lot of consumers are doing their comparative shopping. And instead of going onto their local credit union's website and filling out a loan application, they're going to these marketplaces and they're looking at the available options and they're making their choice there. So it's really important for credit unions to be able to participate in those marketplaces, and we make that happen for them. But we also look at embedding credit union offers in other places. So I mentioned like the retail or the at home service provider. So instant credit approval at retail to make big ticket purchases. A lot of times we can do that in two ways. We can offer a merchant in the merchant side, if they want to offer financing, we can offer a marketplace, so a credit union marketplace that they can their customers can access. So imagine you're at retail, you need $10,000 for something, right? You scan a QR code at the register. 15 seconds later, we're able to tell you all of the credit unions that you qualify to join and how much you're approved for at each of those credit unions and at what rate. So you need $10,000. Great. Here's $10,000 from 3 or 4 different credit unions in your area. You're already eligible to join, and here's the rate from each of them that's being offered, and you can proceed through that offer to redeem the offer and get the funds. Or at home, the other, like the HVAC example I mentioned, and we work with things like roofing companies and HVAC companies and other home improvement type contractors and service providers to offer financing there, and that can be either from a single credit union or through the marketplace. So maybe there's credit union, an individual credit union that serves a particular area, and they want to work with specific retailers or service providers in their area to offer their financing. We can do a one-to-one match as well, where it's not the full marketplace, it's just one credit union matched to one retailer. And then direct-to-consumer is another capability we have. We do direct mailings, we do email outreach under a direct-to-consumer brand that we call Further. And that allows us to go out and prospect for new members on behalf of our lending network.
So you're prospecting for new credit union members?
Yes. So we have about 70 plus credit unions right now who we work with across the country. Each of them every month they put up what we call inventory. So they tell us what types of loans they're interested in funding and how many, right? Either how many loans, maybe I want 400 loans this credit cards this month, 200 auto loans, or they tell us, how much they'd like a total amount. I'd like to do 10 million in personal loans, right? And we go out and we find those loans for them, and we're finding the right types of consumers. There's a lot of targeting and capability here. They say, they give us their risk tolerance and their field of membership, and we take care of vetting the consumers, making sure, that we're running them through multiple layers of identity validation and fraud detection, so that on the other side of these loan opportunities, when we pass this consumer off to the credit union for the loan to be funded, that it's a really high quality lead that meets both their eligibility and their underwriting criteria.
Is there anything that's particularly hot? I mean, when I talk with credit unions about lending, mainly they're just kind of moaning about how it's slow.
I think we've seen or saw a slowdown in the auto and the traditional sort of, the bread and butter was new and used auto lending. It always has been. And there's been a slowdown in that. But for us, what we see as the hot item in our marketplaces right now is mostly the unsecured products, credit cards and personal loans. But credit cards is number one, personal loans number two. And then, of course, we are doing auto loans and other vehicle types and some home equities as well. But the demand right now seems to be coming from the unsecured products.
Now, I know some time ago, there was talk that, let's say, the under 30 crowd was credit card phobic. Is that still true?
Not from what we've seen necessarily in our analytics. That's something I have heard, but I myself, having two sons around the age of 20, I can tell you they're not credit card phobic. They're very interested in them getting their first credit card, and I have to continually tell them that maybe now's not the time. But yeah, I do think the idea of debt is definitely, there is more awareness in the younger generations or fear of long-term debt than what I recall from when I was myself in that age bracket all those decades ago. But tens of thousands of dollars in consumer debt was never. It was kind of the reality for everybody working their way through their 20s and 30s. In my generation, being Gen X, I do see from the younger generations much more awareness and savviness around responsible use of credit, and I think a lot of that has to do with cost of living, and they're aware that retirement is something they need to be saving for and mindful of. So rampant credit use that you saw in the early part of this century, I think I do think the younger generation is starting to not necessarily be credit card phobic, but certainly more aware and savvy about how they use credit.
Well, I think too, a lot of kids are graduating with a lot of student loan debt. And my generation, if you graduate with student loan debt, maybe it was $1,000 or something. Now I talk to kids, it's 100,000. Whoa.
Yeah, no, it's awful what they have to contend with when it comes to their ability to pay back their education.
Now you said you're working with approximately 70 credit unions. Did I get that right?
I don't know exactly off the top of my head, but it's more than 70. I think less than 80.
Oh, all right, okay. And what's the size range?
We have all different sizes in there. Certainly some of the very large credit unions. I guess I won't name names, but definitely have the $5-10 billion credit unions in there. Some quite a bit larger, but then we also love to work with smaller credit unions as well. So it really runs the gamut, and it's really important that we have that mix as well. And the fact that we've built the capability to allow us to target consumers, within their field of membership is we love to help them grow, right? And we need the large anchors in there to make sure that we have ample coverage for areas where maybe we don't have small community credit unions, products that aren't able to reach into certain zip codes or areas. But in where there's large concentration of consumers, there's ample opportunity for all credit unions to play in those spaces, and so having those smaller institutions in there with their, especially if they have competitive rates and products, we can help them grow membership in a very responsible way, right? We're bringing them in, credit-worthy prime, and super prime borrowers, which is just what they need to keep their overall membership healthy.
Well, also you're trying to deliver actual honest to God consumers. And a big worry among credit unions is the problem of synthetic identities. And apparently a lot of them are falling victim to synthetic identities. Whereas presumably you have some checkpoints built into your system.
We do, and we continually optimize those. You're absolutely right. Synthetic fraud, has become, it's just increasingly sophisticated over even just the last year. Just the capabilities that they have to try and defeat the systems that are in place. It's impressive. I don't know if that's the word you want to use.
It's impressive.
But it is.
I've talked. These are sometimes. You'll open an account, a synthetic account, put $500 in it, put $10 in it once a month, keep building it up, never do a thing wrong until 3 years later. Man, this is tricky to detect this.
It is, and if they manage to find their way in, right, to a credit union or any institution, then their goal is to open up multiple products, right, and run those balances up, or use that to the greatest extent that they can before they suddenly go dark, and see that the risk on those individuals is substantial. So what we employ many layers of fraud detection and identity validation throughout the process, and including, really all the standard stuff that you would see with any modern sophisticated sort of lending experience, where we're checking the driver's license, we're running them through multiple databases to look for is their phone, is the phone registered to the right person? How long has the phone been active? Is it linked to any suspected fraud? But all the way through ultimately to a liveliness check when we're taking the driver's license picture to make sure that it's, is it a real driver's license? Is this being taken, on a device, or is it an image that's been uploaded? So it's doing that liveliness check, and then ultimately at the end, a selfie where whoever that is going to have to be on camera, take a video of their face, and we're going to match that against the license that was provided. Ultimately, at the end, we do see dropout as a result. These things can be, either too much for somebody to want to deal with, which they're quick and they're relatively painless, or in the case of bad actors, they don't want to, either they can't pass the checks, or they don't want to, provide the picture of their face at the end. But on the other end, when we send a lead through to our credit unions, we're very confident in that person being who they say they are. We're providing all the documentation and everything necessary to ensure that credit union's risk is minimal.
Now, at the credit union end, what do they need to work with you? And I ask this because I often hear from credit unions, well, we like this product, but it would require too much of my staff right now, and I just don't have the bandwidth on my staff to do this.
I mean, we designed this for, knowing that, right? I came out of the credit union space. I worked at a large credit union here in California for, better part of a decade, and, went through plenty of, implementations of different technology during that time. And then my first company that I started was a company called CUInsight years ago, and we had an on-premise platform that we sold, and that was really, the sales cycle was 6 to 9 months, and then the implementation cycle was 3 more months before the thing was actually live in the market. We knew that with this product we wanted to offer really quick access and a painless sort of experience to the credit unions. So yeah, we designed our product and around the idea of ease of implementation and very low risk to no risk on, when it comes to the pricing model and the obligation of the credit union, on the other side of that implementation. So typically we can get a new credit union live in our marketplace. If not, within 1 month, it would be certainly within 2. We run monthly cycles. And so depending on when a credit union begins that implementation, we might be able to get them live as little as 2 weeks, but never longer than like 6 weeks. Very low friction on getting set up. We're integrated to all of the major origination platforms. So we just light up those integrations. We input their underwriting and marketing content into the system, and a lot of times we're able to pull that right off their website or through an export from their LOS. So very, very easy to get live. And then we're success-based. Our fees are all success-based. So, no upfront cost, no long-term commitment. You pay for what you get, and you tell us what type of members you're looking for, and we go out and find them. And when we bring them to you, that's that's the billable event.
Why does a credit union say no to you? I mean, I just heard your little pitch there. It took like 2 minutes. I said, well, my heavens, I don't have any risk if I'm a credit union.
Yeah, we don't get a lot.
The guy brings me no customers. I don't pay him a penny.
Well, that's the idea, right? There should be very little reason for somebody to want to say no. It's not a bandwidth issue. It's not a risk or a budget issue, because if you're working with a small budget, we'll work within that budget. It's all it does is, ultimately it's limiting the number of new members we might give you in any given month, right? The ROI is quite good. Why they would say no, I don't know. I mean, maybe they don't want new members, or they don't want to front loans. But I think that's why we have so many lenders in our network so quickly. We've only been in business for a couple of years, and yeah, we represent credit unions across the whole country. The marketplaces we work with are sought after. Yeah, if I'm a credit union and I would love to have my offers show up in the Experian app, there's really only one place to look, and that's Union Credit. They can't go directly to these marketplaces and participate directly because minimum pricing's prohibitive, and these marketplaces don't have the concept of a credit union eligibility engine, right? That's really the key. Is they all the marketplaces want to work with credit unions. It's not that they're anti-credit union at all. They really, really want to work with them, but they don't have the ability to vet the leads and check their eligibility. And so we provide all that out of the box in one centralized place. We aggregate the network together, and we provide these marketplaces a kind of a plug and play credit union capability.
And that's really a special sauce that you have where, as you know, field of membership is often wonky. It'll be like 7 counties in Iowa. It's like, hey, man, how am I supposed to know? I see the street address. I don't know the county.
Right. That's, and that goes also back to the awareness from the very beginning of this conversation, where we're talking about consumers and their awareness of credit unions and their ability to join a credit union. We are also, so in our experience, what's happening is, I imagine you open your Experian app on your phone and you're seeing credit card offers from, any number of banks, fintechs, and now, credit unions. The credit unions that you see that are, presented by Union Credit, that person's already eligible to join. We don't show that credit union unless that individual's already eligible to join it. So, and then our messaging reflects that throughout, so that consumer says, oh, that's a great rate on that credit card. I'm going to click and learn more about that. We're making sure that they understand you are eligible to join this credit union. You're pre-approved for a loan, and you're pre-approved for membership. And then they click on that, and we actually memberize through a very quick process when we call redeem that loan or credit card offer. Right? They click on it. It's just about 2 minutes to get through. When we pass that through to the credit union, they have everything they need to establish that individual's membership and the new account. And it's all in one flow. So there is no membership application that follows up. It all is done in one workflow, which is really, really important to that consumer experience. We're just eliminating the whole thought process of, well, I don't even think I can qualify. We're just kind of magically memberizing them and giving them the loan they need all of also.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey again. That's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.